Hi, everybody. Jeff Rivett here, Portfolio Manager with Creed Capital Management Group at National Bank Financial. Hope that everyone's doing well and getting through this last bit of dark and coldness before we enter into spring. And certainly in the portfolios and in the market, it's already been a bright start to the year. We're only 2 months in, and we've seen sort of a continuation of what we saw at the end of 2023, where prices and markets seem to just keep cooperating with us. And certainly in our balance model, just really happy with the results we're seeing. We're currently sitting up about 4.5%, up to the end of February, which is just great. Looking at the average balance fund in Canada, is sitting around sort of 3.5 to 3.6% for the first 2 months of the year. So still very good performance for 2 months to make that much money. But the fact that we've surpassed that, currently are surpassing that sort of average by about 1% net of fees is great, and it's really a testament to really just us being in the right place at the right time. The last 3 months, or 3 or 4 months, I think really starting in November, as I'd mentioned, we started to move into long bonds, specifically into the iShares long-term treasuries ETF. And we did that move when interest rates were sort of near their peak. And as I've said before, bonds move inversely to interest rates, meaning that as interest rates went up over these last few years, bonds were just a terrible place to be. But as we're seeing them start to come down, they're looking pretty good, and we were able to really capture that investment in November, pretty much, I guess, near the bottom of the bond cycle and near the top end of rates, and have continued to be able to ride that. Same thing with preferred shares, and I've mentioned this sort of every month now, it seems, for the last 2 months, but the story continues. Preferred shares is an area that I've been doing this for coming up on 16 years this year. And it's been an area we've just continued to be able to have an advantage in, being sort of a big enough player, but in a small area of the market, where we've just been able to time the ups and downs of preferred shares over the years, and it's been great. And seemingly this year, we've seen tremendous gains in that space as well. And that's an area where we had really no exposure at all 12 months ago, and now it's 10% of our balanced portfolio, and the ride's been great. And looking at sort of those fixed income safer investments versus equity investments, I'm also really proud of the fact that not only are we outperforming right now compared to most balance mandates, but we're actually outperforming with a lot less risk. We're currently at about 56% equity exposure, just because of the some cautions that I think are warranted, versus the average balance fund is sort of 60 to 65%. So not only do we have about 10% less risk exposure in equities, but we're also continuing to be able to perform well thanks to just some excellent bond picking. And then the investment side, like on the risk side, we've also been well positioned. I think looking at some of these returns in the last month in the resource space in Canada, looking at Meg Energy, Topaz Energy, Suncor, in those names in the energy space, up 20%, 15%, 9%. We also have Capstone Copper, which is a resource, a big, small copper company, but fairly large copper company, I guess, locally. Up 9%. And then the banks are doing well. National Bank and Scotiabank both had outstanding earnings, both core names in our portfolio, both have about 6 or 7%. So those equities have been really strong. The U.S. has been sort of a mixed bag. I think that we've done a really good job of managing our exposure to the big tech names. And I've mentioned, several times how these, Microsoft, Apple, Google, Tesla, Nvidia, Amazon, these companies have really come to dominate the U.S. market. And not owning them has really been at your peril, because they've been where most of the performance has been. but it's also a lot of risks because those sort of those few companies have become such a dominant piece of the U.S. market. And we own our share. We own Google, we own Amazon, we own Apple, we own Microsoft, but we've really been limiting our exposure. And as they've been going up and growing, we've been paring down and keeping that in check, and that's worked out really well. Especially this month when we've seen a pretty significant sell off in Apple. Well, I shouldn't say significant, but about 10%, and in Google about 8%. So again, a pullback, and nice not to have all of our eggs in that basket. Also, I'm loving to see my favorite stock, Walt Disney, up 14% this month. I don't get to say that very often, so I'm happy to be able to report that. But again, just another really undervalued company that we've been invested in for a long time, and great to see some of those returns being captured. And then I think lastly, where our positioning has been really strong. And I see my monitors have gone off behind me there, but lastly, where our positioning has been really strong is in gold. Gold's had a run. We're at an all-time high in gold this month, and again, that's a piece where we have about 6% of our balance model focused in that area. And I love gold both because it's underpriced, I think, compared to where inflation's at, but also provides that safety hedge. So if things go wrong, if markets turn, it gives us that asset that's going to hold in there. That historically has held in and given us something that we not only can sort of buffer the volatility, but also give us something that potentially we can sell off and take advantage of cheaper equity prices. So again, just right place, right time. These last few months has really paid off for us, and super happy with how things have gone. Now, going forward, the story has kind of been the same the last few months. We're seeing the expectation that rates are going to come down, so that's fueling the market. A lot of excitement around AI still, so that's powering the tech stocks. And I think that the theme that really hasn't gone away, that I've been talking about the last few months and continue to, is this idea that that it's likely that we're going to have a recession, and that's sort of the major reason that we are positioned the way we are, in a more conservative way, having less equity exposure and really being selective with our names. When we look at the indicators, things like unemployment is creeping up, credit card and loan delinquencies are creeping up. We're seeing wage growth start to slow. We're seeing spending start to slow. So these are all normal, but not necessarily normal when you have market prices that are as high as they are. And the markets have been sort of flashing potential recession signals for quite some time. And again, I've said before, recessions aren't the end of the world. We can manage through them. I've personally managed through two of them in my career, and the average return during recessions, notwithstanding 2008, is really not that bad. But it does really speak, I think, to our method to managing money right now, which is being cautious, keeping our focus on those safer investments that are yielding, the bonds and preferred shares that have great yields because of where interest rates are, and just being selective with our stocks, and being positioned and not getting too caught up in some of these really highly valued names, and just sticking with our process. And it's nice when it works, and I'm gonna ride that for a while. So if you have any questions at all, tax season is we're sort of in the throes of it. If you need any documentation from us and our team, you know where to find us. If you need to speak to me directly, you know where to find me. Until then, I'll talk to you next month. Have a great one. Take care. Bye-bye.